Hello traders, and welcome back to another In-Depth with Chris episode. In today's discussion, we're going to talk about something that has existed for a very long time, something that came about in the 1930s, yet there's still a surprising number of traders that have never heard of it. What we're talking about is a cumulative indicator called the NVI, otherwise known as the Negative Volume Index. It's made by the same individual that made the PVI, if you've heard of that, and yes, that does stand for Positive Volume Index. We're going to go through a crash course on what the NVI is, and at the end of all of this, hopefully you'll have a better understanding of what it is and whether or not you want to pursue your educational background and experience with it even further. Let's get going. The Negative Volume Index, otherwise referred to as the NVI, which is probably how we'll refer to it from here on out, is a cumulative indicator that shows how days of low volume affect price movements, which is opposite of the Positive Volume Index, which we'll refer to as the PVI. The PVI generates trading signals based on an increase in trading volume, while the NVI, the Negative Volume Index, focuses on down volume days. The NVI indicator assumes that large-scale investors, aka the smart money, like institutional investors and funds, are more active when the trading volume is actually low. In other words, the NVI tracks the movements of professional investors by monitoring day-on-day volume changes. This is based on the idea that days of significantly high volume are periods when uninformed investors are dominating the market. The NVI appears as a technical indication line that uses the security's price and volume to help traders see price changes on down volume days. Now, just like the PVI, the NVI was also designed by Paul Dysart in the 1930s, and they both became increasingly popular in the 1970s following Norman Fosbeck's book, Stock Market Logic, which many of you have probably heard of. The NVI is considered among the best trend lines for monitoring smart money investors' actions. As opposed to the NVI, the PVI trend lines are more related to periods of increased volume, which come as a result of the involvement of both smart money and noise traders in the market. The NVI is particularly useful when a security's price declines following a period of high volume trading. While the indicator primarily tracks the trading moves of smart money investors, it is generally advised to use the NVI and the PVI in conjunction. Together, they provide a broader picture of how a security's price is affected by the volume. Generally, traders compare their NVI against a 255-period EMA. According to Fosbeck, if the NVI is above the 255-period EMA, there is roughly a 96% chance that a bull market is afoot. On the other hand, if the index is below, as we can see on the left here, below the 255-day EMA, there is a 53% chance that the bears have taken over. Now that's Fosbeck's view. It's open to interpretation, as with all things in the trading world. It is important to note that the market hasn't necessarily turned bearish if the NVI is below the long-term MA. It's just more so meaning that the chance of turning bullish is below that 50% mark. So, the general concept here with the NVI is that we're looking to generate signals to buy a security while the price is on the rise, yet the volume is declining. So if we take a look at the chart on the left, we have a buy example here, and the reason we do is because the general trading strategy that goes with the NVI is looking for a signal line cross. When the signal line crosses the 255-day EMA, put simply, we'd be looking for some type of justification to get into the market for the market to rally. The opposite holds true when we're above the 255 EMA and then we cross below it, as we can see on the right. In this scenario, we'd be looking for an opportunity to short the market. This is due to the fact that it's showing us an increase in pressure of possible institutional sellers. Of course, we want to use outside technical analysis and other means of confirmation before blindly buying or selling based purely on the NVI. There are traders, however, that swear that the NVI is the meat and potatoes of their strategy, but it'll be up to you to decide how much merit that you wish to provide it. Now, let's take it a step further and look at another example and talk about how we can generate an exit location as well as a stop loss location while trading with the NVI. If we look towards the bottom center of the screen, we have an entry location marked off here, and that's because we're seeing a buy signal triggered by the NVI crossing above the 255 EMA. If we follow that up, that gives us a buy location on the market right somewhere around here. Now that's all well and great, but we need to know where to set a stop loss, as any responsible trader should want to do, and a time when we need to call it quits. Well, a lot of traders like to pertain to or adhere to the idea that the most recent swing low, just outside of that, in relation to where this buy signal has been generated, can represent a very good stop loss location. If perhaps the most recent swing low is much farther away than you feel comfortable making your stop loss, we don't have to enter that trade, or we can modify it through other means. This is just a general way to come up with an idea. Now, as far as generating an exit, how do we do that? Well, we can ride this train until this train begins to shift its momentum, which can be identified when the NVI goes ahead and crosses back below, in the case of a buy to begin with, when the NVI crosses back below the 255 EMA, which, if we follow that up, would be somewhere around here. Now, yes, this particular example is probably more like a one-to-one. It's not a spectacular example, but if the market were to keep trending, it's not hard to imagine how much of a ride we could really gather out of a strong bullish swing here while keeping our risk relatively low. So what have we learned about the NVI? Well, it is a technical indicator that considers both volume and the price of a security in order to better give the trader an idea of what's going on and by who. It is very common for traders using the NVI to also use it in conjunction with its mirror image brother, the PVI, the Positive Volume Index, and it's possible to take a look at both of them to get a better understanding of the market by paying attention to things like divergences between the readings, as well as what's going on with price action itself. At the end of the day, it's going to be up to you to decide what information you find valuable and what type of confirmation you're going to need before you finally pull the trigger, but you'll never know unless you dive down that rabbit hole for yourself and try trading with the NVI and see how you like it. Until next time, I will see you soon. Good luck and happy trading.